Liberation Day, April the 2nd, the amount of gold that's been stood for delivery is about 250 tons.
Mm-hmm.
250 tons. And the interesting thing is that since that time, the warehouse stocks have contracted by almost exactly the same amount. Well, the way I always look at gold is it's not gold going up, it's the paper currency, you're measuring it going down. I mean, it's really as simple as that. I mean, in dollars, remember that it was $35 to the ounce. That was the official rate when it went off the gold standard, the Bretton Woods agreement. And we're close to 1% of that now in terms of the dollar's purchasing power. That's actually what's been happening. These aren't traders buying gold. These are people getting the hell out of fiat. They're not going to get back into fiat. That gold is gone, vanished.
Gold prices aren't rising at the moment. In fact, they're pulling back sharply. Instead, fiat currencies like the dollar and pound are collapsing in purchasing power, with the dollar down to about 1% of its former value since it left the gold standard. On July 7th, gold prices paired earlier losses on Monday after U.S. President Donald Trump announced a 25% tariff on goods from Japan and South Korea starting August 1st, prompting some safe haven interest. However, a strong U.S. dollar continued to add pressure on the yellow metal. Since April 2nd, Liberation Day, around 250 tons of gold have been stood for delivery on COMEX, with warehouse stocks shrinking by nearly the same amount, suggesting heavy physical demand. Crucially, this gold isn't being bought by traders seeking profit, but by individuals fleeing fiat currencies permanently. As a result, that gold is effectively gone from the market and unlikely to return. Alasdair Macleod, a seasoned economist and precious metals analyst, explains that the dramatic rise in the price of a gold sovereign, from £1 pre-World War I to £600 today, reflects the collapse in the paper pound's purchasing power, not a rise in gold's value. Current market conditions and expert predictions suggest a continued increase in gold prices, which could further boost the value of sovereigns. Moreover, the Bank of Finland currently holds around 49 tons of gold, said Jukka Lehtomäki, senior market analyst at the Bank of Finland. The value of gold has risen significantly over the past 20 years. The price of the precious metal has been at its highest level in more than a decade since the beginning of April. At the current market exchange rate, the value of Finland's gold reserves is around 3.4 billion euros. According to Lehtomäki, the value of gold has risen 30% since 2022. Gold is stored in central banks in the form of gold bullion, which includes gold bars and coins. Lehtomäki estimated that one gold bar weighs about 12.5 kilograms and is worth about 900,000 euros. Only a small proportion of Finland's gold bars lie in domestic vaults. Lehtomäki said that the state's gold is also stored in central banks in Sweden, the United States, England, and Switzerland. Since the paper gold market relies heavily on leased and rehypothecated gold, this breakdown poses a threat to its liquidity. As gold disappears from vaults and physical delivery becomes difficult, systemic risks grow, not just in gold, but across the broader derivatives market, since the same players, banks, hedge funds, operate in both. The unwinding of the gold paper market, and potentially fiat itself, could trigger a major financial crisis. We're about to explore the video, but first, please subscribe and hit the bell icon to stay up to date with our latest uploads. Your feedback in the comments is always appreciated.
In the case of sterling, I mean, we've got an even longer history because before the First World War, you could exchange one paper pound for one sovereign. The sovereign now is 600 paper pounds. What's happened? Has the sovereign gone up? No, it's the paper pound going down. It's a far better measure of the loss of purchasing power of a currency than, say, consumer price index, which gets fiddled, as you know. That's the way I look at it. And I see the dollar is going to continue to go down in terms of its purchasing power. It must do. It's certainly not going to recover. I mean, any recover would be extremely short-lived. But that is a fascinating story. So far as I was aware until fairly recently, I was the only person talking about the stand for delivery on COMEX. They are absolutely massive. And funnily enough, I was looking at these numbers the other day. Up to now, Liberation Day, April the 2nd, the amount of gold that's been stood for delivery is about No, 250 tons. 250 tons. And the interesting thing is that since that time, the warehouse stock have contracted by almost exactly the same amount. Now, I think there's a degree of coincidence in there because there are leads and lags in terms of stands for deliveries and actual withdrawals from the warehouse system. But it's these stands for deliveries which are important. So let's go back a little bit. When we go back to the beginning of this year, you saw big premiums on COMEX. And these premiums came about because there was a concern on COMEX that President Trump would introduce 25% tariffs on, because that's what he said he would do, basically. And so they thought, well, gold and silver, okay, we have got these stands for deliveries, we've got these obligations, and we've got to make sure we've got the cover. So you can see that this, to a substantial premium on the futures, that created an arbitrage, if you like, COMEX and other centres, whereby physical gold was moving from other centres, principally London and Switzerland, but even Mumbai was involved in this. You know, effectively the bonded warehouses in Mumbai funneling some of their gold over to COMEX as well. This is a substantial move. Not only that, but this stuff was coming out of the Bank of England. Now, the Bank of England does store some gold on behalf of commercial entities, large funds or whatever. This gold, basically leased gold. So huge numbers have left the Bank of England and also the LBMA and gone over. Guess what's happened is that the arbitrageurs in the papers market, I mean, there must do. You working that sort of derivative, you put a cap on your potential losses if gold continues to go up. Meanwhile, you look forward to the opportunity of closing they only temporarily own, so they've got to get it back. Now, if it's being delivered out of COMEX vaults and stand for deliveries, then where's this going to go? How are they going to get this gold back? That's a big, big question. Now, I've been the only person, to my knowledge, really sort of pushing this line as an explanation for what happened. But then about 3 weeks ago, we had something from the ECB, because the ECB was concerned about the increasing level of derivative exposure in precious metals and particularly gold as a result of what happened. And they described exactly what I said. They said that gold was going over there. You had stands for deliveries in COMEX. The gold has effectively disappeared. What's happened is that Eurozone institutions have increased their paper derivatives by 58%. In other words, the coverage isn't physical or paper. So we had the story confirmed by the ECB. I think that's a very, very important point. It's not just me shooting off in the long grass. How do we get this back? It's gone. We don't know who stands for delivery, but we're pretty sure that these are hoarders, not traders. I mean, I was listening to someone. I think it was probably someone like John Reed or someone from the World Gold Council, and he was assuming that the rise in price would create the profit opportunity, which would bring the stock back into the market. By stock, I mean physical bullion. If and the key to this is to understand these aren't traders buying gold. These are people getting the hell out of fiat. They're not going to get back into fiat. That gold is gone. We don't know the answer. I would suppose that they are smaller central banks. I think they're sovereign wealth funds, and I think they're the super rich in Asia, of which there are now many, 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 many ultra high net.
Open interest in gold futures has declined dramatically, falling from approximately 800,000 contracts to around 430,000 contracts. This reduction signals a decline in liquidity in paper markets as participants increasingly opt for physical settlement. Reports from major financial publications have highlighted significant delivery delays of 4 to 8 weeks for physical gold. These delays reflect genuine supply constraints and have contributed to growing concerns about counterparty risk in the gold derivatives market. Alasdair Macleod discusses platinum and related metals, noting that despite their critical industrial use, mainly in automotive catalysts, prices have remained low for a long time, possibly lulling buyers, such as car manufacturers, into a state of complacency. A sudden supply crunch could catch them short and drive prices sharply higher, as seen in past spikes with metals like rhodium. He points out that many commodity funds are now breaking out, suggesting rising demand and price floors across the board. This rise in commodity prices can squeeze industry, trigger closures, and expose the falling purchasing power of fiat currencies. Governments often respond by printing more money to shield voters from higher costs, further devaluing currency. Though fiat declines aren't always steady, there are calm periods and panics. Eventually, a significant drop in the dollar's purchasing power will ripple globally, given its central role in the financial system. Now, let's get back to the interview.
I think it's bound to, because all these markets are basically priced on the back of derivatives. And, if you can't hedge, let's say your copper or whatever, because of party risk or whatever, then obviously it's going to have an impact on underlying prices. It must do. I would think it would lead to relatively immediate demand for virtually all commodities, because the point about derivatives is that you can have a derivative without actually having to own the stock. So, you can always use derivatives to protect your price ahead of delivery or ahead of a commitment. But when you can't use the derivative anymore, then you've obviously got to go out and get the stuff in because you're going to have obligations, if you like, on the other side in terms of delivering, whether it's mild steel or copper or silver or lithium or whatever it might be. Yeah, and also oil too, energy. That actually could be a very, very big. Yeah, that was a rather different situation. The problem there was the incompatibility of the delivery on a contract. You had some Chinese business, which was a very, very big dealer in nickel, but they couldn't deliver nickel in the form in which the contract was set. So in other words, they defaulted on the contract. Is the problem that any market has, acting as an intermediary between different parties, is that the market itself takes on the counterparty risk. You deal with the LME, and you sort of you're guaranteed by the exchange, as it were. But that only happens to the extent that the LME can actually deliver on its obligations. So it has this protection in its own rules that, it can, under certain circumstances, cause contracts to be cancelled, which is what it did. And, obviously quite a few people were upset about it. I don't actually follow it too closely. In fact, I hardly follow it at all. But what I would say is that the price has been in the doldrums for an awfully long time. I mean, as you can see, going back, it's a very, very important metal. I mean, it's important from the point of view of exhausts. What we call exhausts. I can't remember what you call it in America. The tail end of the car, as it were.
Yeah, the exhaust.
Your catalysts, anyway. Automotive catalysts and things like that. It's I would guess that rather like the silver market, we've had a long period of lack of supply given the level of demand, and I'm not quite sure how this is sort of, sustainable in a sense. But of course, when things begin to break, things like that really do run. And I would think that there's a good possibility that a few people in the market have got themselves caught rather badly short. I mean, for example, I could imagine motor manufacturers may be sort of thinking, well, we can always get hold of platinum because the price never goes anywhere, and find suddenly that they're uncovered. So they've got to go in and buy and drive the price even higher. So I would, I can't see there's anything more than that. I mean, palladium is the other one, of course, and they've been using palladium a lot more in catalysts for motors, and that has been a lot more volatile. And the other platinum group metal, rhodium, I don't know where that is now, but I mean that was just completely unobtainable at once, and it was up at something like $14,000 an ounce or something. I mean, I don't know where it is. I haven't seen rhodium for an awful long time. But you used to be able to trade in rhodium, but basically there was none available, so there was no trade. And I think that certainly does feed through. What it does is it puts a floor on prices, certainly of consumer prices. It squeezes industry very, very badly. And quite a lot of industry might even have to close down on it. And yes, it sort of front runs what's really happening to the currencies, because what do governments do under these circumstances? Well, if you get a sort of commodity prices driving prices up, you can't possibly have voters doing without. So you print the money one way or the other for them to be able to buy things at a higher price. You're getting cause and effect a little bit sort of muddled here, but I think that's basically what happened. But I mean, it's the fall in the purchasing power, which is really behind it all. And of course, when you get a fall in the purchasing power of a fiat currency, it doesn't necessarily do it on an even, sort of downward curve. There are going to be moments when you get panics which work against the currency, and you're going to get periods perhaps of the panic has passed and there's a little bit of stability. Like this summer, nobody's considering anything, and okay, the dollar's going down, but the other side of that is the euro's going up, the yen's going up, sterling has even gone up, and you sort of begin to think, well, at some stage, their purchasing power is really going to go down because the best currency in the G7, of course, the leading currency in the G7 and around the world is the dollar. And if the dollar tanks, if the dollar's got problems, oh my God, we've got problems. You get a cold, we get pneumonia. At some stage, that's going to happen.
The apparent price stasis of gold masks a larger trend: the depreciation of fiat currencies such as the dollar and the pound. With COMEX facing record delivery demands, dwindling warehouse stocks, and declining paper market liquidity, the rush to physical gold is intensifying. This shift, driven primarily by entities wanting to avoid fiat risk, indicates a profound lack of trust in the current monetary system. As actual gold becomes more scarce and derivatives confront greater counterparty risks, broader systemic stress is expected to emerge, not just in precious metals but across global financial markets. Meanwhile, the undervaluation of industrial metals such as platinum might pave the way for severe corrections, particularly as inflationary pressures and supply shocks converge. What happens if central banks start repatriating leased gold and abandon the paper gold system completely? Could an industrial metals supply shortfall spark a global wave of inflation? We welcome your insights in the comments section below. If you found this content valuable, don't hesitate to give it a thumbs up, and don't forget to subscribe to stay informed.